Good morning, everybody. This is Rick Chafey with Ask the Masters. We are been running a number of programs for everybody to talk about the Paycheck Protection Program. I think this is probably going to be one of the most important ones we've talked about, because this is not about how to get your Paycheck Protection Program put together, but this is more of how to get those dollars forgiven once you actually get those in your account. And you need to start that almost immediately when that money arrives. What we've done today is we're bringing in a certified public accountant, Diane McCauley. She is my personal business accountant as well. We are not here to give you legal advice. We want you to make sure you've talked to your accountants, you've talked to your CPAs and your attorneys if need be. But what Diane has done has dug in super deep into the program, has a very good understanding of what she thinks the tests and requirements are, and a proper way to account for that money and make sure you get as much of it forgiven as possible. She is going to go through a number of spreadsheets and templates. We are going to make some of those available to you on our website as well. But what's most important is pay close attention, listen to what she's got to say, make sure you protect yourself and get it covered. So without further ado, Diane McCauley, welcome to the Ask the Masters program.
Rick, thanks a lot. I appreciate you having me here today. I do want to talk a little bit about how to get your PPP loan forgiven. And I want to start out by saying there are a number of things that we don't know with the CARES Act that's come down. As you know, one of the things that I want to talk about is the fact of what we don't know, because if we know what we don't know to begin with, then it's going to be a lot easier to realize that some of the things we're going to show you today are based on some assumptions that the profession has made based on the lack of information. And so this recording obviously is being taped on May 7th. There will be additional guidance come down about every week or so. The SBA is coming out with their FAQ and adding additional information for us. So with that being said, I do want to talk about some things that we're waiting on guidance for, because that's going to involve some of the assumptions that we're making while doing these tests. One of the biggest items that everybody knows that we're waiting on is, we don't know, in the CARES Act, it says cost incurred and payments made is one of the things that they go into. We don't know what that means yet, and we are desperately waiting for the SBA to come out and identify that, because it is so critical. From the day you get your loan, you have 8 weeks called the covered period to spend the money properly. But the problem is, the requirement is that the cost incurred and the payments made within the 8 weeks period will be forgiven. But we, again, don't know if it is both the cost incurred and the payments made, or they have to be both incurred and paid. So that is one piece of guidance that we're waiting for, that is going to become critical down the road. The second thing that we want to talk about just a little bit is, as everybody probably knows, the PPP loans that are forgiven are not taxable. The IRS has recently come out and said that because they're not taxable, any of those funds used for PPP that become forgiven, those will not be deductible. That was a piece of guidance that just came out about a week ago. I just want to let everybody know that the AICPA as a body disagrees with this. They believe that, bear with me one second, they believe that this is not in the way it should be, and that they have written a strong letter, and they are currently arguing that fact. Their position is that the CARES Act itself does not address whether deductions otherwise allowable under the code will still be eligible. So they definitely believe that these deductions should still be deductible and not deductible because the loan's forgiven. So that's something I want you to kind of keep in mind as we talk about this.
Because that'll affect,
having said all that,
that'll affect you at the end of the year, what you can, whether you're deducting this. Explain how that's going to affect you tax-wise, potentially.
So right now, with the IRS, the way they've come out with this interpretation is, if the money comes in and it's forgiven, then it makes sense that the funds that you're not paying tax on wouldn't be deductible, or that would be in fact a double dip. But even though it is a double dip, the AICPA believes that strongly that the IRS's new interpretation denying the deduction of the expense is contrary to Congress's intent. So even though it would be a double dip, the AIC is fighting very much for the fact that they think that those deductions should still be deductible. So we are waiting for Congress to kind of step in on that one and give clarification, even though the IRS has. So having said those two things kind of that we're really waiting on, I'll kind of go into where we are. So there's one other item. Well, I'll touch on that in a minute. So basically, in order to get your PPP loan forgiven, there are 3 steps that you have to take. We're going to be talking about a couple of different terms. One of them we're going to use often is called covered period. The covered period is the 8 weeks from the day your loan is funded. That means the day it was deposited into your bank, exactly 8 weeks out. It's not 2 months. It's not the 12 weeks. It's exactly 8 weeks. So that's what we call our covered period. Now, in the 3 different tests, which are the first test we're going to talk about, is maintaining your FTE, which is full-time equivalent. One of the things we don't know, because we haven't been given guidance from the SBA, is how to calculate an FTE. But based on the area that the code that this is in, we believe it's going to be similar to other things in this particular area of the code section. And so we're using 30 hours per week as an FTE. So in the examples that I show you, we're going to be using 30 hours. And in the example that I'm going to show you with the FTE test, we're using a biweekly period. So in the FTE, there's a look back period, and you have to maintain, one of the rules is that you have to maintain your FTEs. We have 2 look back periods that we compare it to, and we can run tests on both. Is my screen being shared right now, Rick?
Yes, it is. So we can see your screen and your spreadsheet with your 3 tests.
Okay, perfect. So this is actually just one test. This is actually just the FTE test. There are 2 testing periods during that FTE test. The first period that you can choose either one of these periods to look back and test your FTEs, is from February 15th, 2019 to June 30th, 2019. So what you have to do is you have to go back, and so what we've done down here is we have imported data on each one of these pay periods. So this particular pay period ended February 24th, 2019. So we imported everybody's hours in that pay period. And so anyone who had 60 hours or more is considered one full-time person, and we have a 1 here. Anyone who is under 60 hours, we put their part-time hours down here. And then at the end of the pay period, we add up all the part-time hours and divide by 60. And that tells us how many part-time equivalents we have. So in this example,
the reason you're using 60 in this example is because you're doing a 2-week pay period, right? So you're basically saying,
that's correct.
You consider somebody a full-time equivalent employee. They work at least 30 hours a week. So that would make 2 weeks equal 60 hours. So anybody that's under 60 hours, we're not considering full-time currently.
That's correct. So they don't count, instead of counting as a full-time person or equivalent, we are adding their hours, and we're adding everybody in that group together and dividing by 60 to get, 30 hours per week to get us a full-time equivalent. So that's how that's calculated.
And then if you go back essentially you're figuring out if you might be taking 25 employees, but that equates to, in this spreadsheet, 11.8 full-time employees.
That's correct. And if you look at the summary, back to the summary tab, that's what each one of these pay periods does. This just basically is the page that we're using to summarize all of our data in our data field. So that particular pay period is right here. We have 11.88 part-time equivalents, 16 full-time equivalents, for a total of 27.88. And this isn't necessary, but we are maintaining that we had 31. We are doing an actual employee count over here. So when you look at it, we take the average of every pay period in our look back period. Again, our look back period is that February 15th. And our average FTEs during that time was 24.898. So then we do the exact same thing, but the second test period that we calculate is from January 1st, 2020 through February 29th, 2020. And we do the same exercise. We import all the data, look at the hours, and calculate what that FTE for full-time and part-time is for a total FTE. And again, we average these 4 pay periods out. If you were weekly, it would be 8 pay periods. So once you get your data sets and you know what your average FTE for the look back, you get to pick the lower of the two. So in our example, we want to use this particular pay period because it's a lower FTE count. And in order to get your loan 100% forgiven and meet this test, you have to maintain those FTEs. So then what we're doing is, here's the covered period. So we're going down, and our first covered period in this example was this payroll ending in April 23rd. So we go down to the covered period. Again, we import our data the same. We get our total hours worked, total full-time equivalents and total part-time equivalents, take it to our summary page. And so far, we only have 2 pay periods in here, but so far we have part-time equivalents of, FTEs of 28.876. So we know we're going to meet our test in this area so far. So we continue to bring that data in. So the thing that I want to point out here, and that we're doing and encouraging all of our clients, don't wait till the end to get it forgiven. Know that you're meeting your targets now. Use your data to your advantage and know what you need to do. Don't calculate what you did at the end, because then it will be too late.
Right,
so
it's
you would
critical
that
you would
people
actually have to go back in. You would end up having to go back in and backdate payroll, which would not be correct or legal, right? The intent is here to maintain your numbers, essentially, which is a complicated way to explain. We're making sure we maintain our full-time employment numbers through the entire pay periods that we receive the loan. And the best way to do that is starting on day 1, not on pay period number 8 going, oh no, I don't have enough in my pay period, right? We can't correct payroll. Yes. We can't correct our payroll from weeks past because it's already happened.
Yeah, having said that, Rick, that's a really good point. I do want to point out that there is a forgiveness, if you will, at the end. I'm not going to touch a lot on that today, but you can restore your full-time equivalents and your pay by June 30th. But my advice to my clients right now isn't let's just see what happens and try to restore it at the end, but be proactive. And, as I remind my clients, you were given this money to maintain your payroll. So our goal right now isn't to get it forgiven within the grace period and to restore everything. It's to make sure we're meeting all the requirements. Here's one thing that I believe. What's going to happen is, as you know, there was a rush to get all the PPP funds as soon as it opened up.
Right.
You have 90 days to submit your data. And what we don't have any guidance for yet is how are they going to forgive it? How are they going to calculate this? I have seen so many loans where banks didn't even review the data that was provided to them. And I saw one the other day that they were actually given their PPP loan based on shareholders' distributions. I was flabbergasted, but what that led me to believe is the banks weren't looking at it that closely. It's still on the taxpayer to prove that. So what I'm concerned about is when we go to submit this data to these banks who are not necessarily equipped to look at it, the more organized we can be and the more we can walk them down the path of, hey, here's our data, we met all our tests, forgive it. So that's why I'm advocating, at least to all of our clients, to make sure that you get this in order now so you can easily submit it. As soon as this 8-week covered period is over, you have 90 days to submit it. The banks have 60 days to review it, but we want it forgiven. The whole point of this is to get the loan forgiven. So we want it forgiven right away.
Correct.
So
and pre-planning is going to get
FTE
you way
test.
farther down the road. So there's the smartest thing you do is plan ahead and make sure you're putting in and the other thing is being critical to what we're supposed to do here. The intent is to maintain employment counts and get the money into the employees' hands so that they can stay in the same livelihood they had and they can take that money and put it into the economy. That's the goal. And maybe the best thing about this whole program is as long as you've done what you're supposed to, you've put all this money back into the consumer, your employees and families that work for you, they're hopefully going to, as soon as they can, start applying that back to the economy so that we keep our economy moving. So there's nothing against, this is making sure that you're doing that from day 1.
Absolutely. That's a good point, Rick. So this is test 1. This is the first test, the FTE test. We're going to move on to the average wage test. which again has nothing to do with hours. This is strictly based on hours. You can see there's no compensation anywhere, and it just is based on hours. The second test, which let me pull that up real quick, is the average wage test. And the average wage test is based on individual employees. So this is where we pull in our employees that we had the entire first quarter. And what we've done is we've imported every payroll in the quarter, and we have an average of quarter one. So here is the average. Let me just get this a little bit bigger. Here is the average for quarter one right here in this particular data set. So what we have to do now is compare everything in this quarter to 75% of that. So the CARES Act says that the second test is you have to maintain at least their salary at 75%. The actual CARES Act says it can't decrease more than 25%, which is it needs to maintain at least 75%, which is a little bit easier way to look at that. So what we've done is we've taken the average of every single employee, times it by 75%, and then this is the next two test periods, and anything in red, they're falling below that 25%, excuse me, the 75%. So we need to make sure at the end of the covered period that we bring that back up, or we will have part of that amount that they didn't meet the test will not be forgiven. So, you know, I've had clients say, well, hey, they're not working. What do I do? Well, again, the whole point is to pay them anyway. You've been given the money to pay them, incentivize them. I will tell you this. I've had a couple of clients in the construction industry. They've decided to bump up their pay of their workers by $100, you know, a week or whatever, just to make sure that because they were given the money to, you know, kind of show a little bit of appreciation of their employees coming in during this time, and also help them meet the test. So
Sure.
I think that was a win-win for some of those guys, because they were allowed to kind of look like, hey, we're trying to help you guys out. We're going to give you a little extra. So anyway, that's the second test. So it's critical now. You can all go back. You can all go in and run your data to see what is your average per person, and take 75% of that. Here's what we don't know. And here's what we're still waiting on guidance from the SBA on this. Obviously, this is a 13-week comparison to an 8-week covered period. So they want you to compare your average in quarter one to the average in the covered period, but they haven't said, you know, that this exact methodology that I'm using here is the methodology. We anticipate that it will be. Again, they wrote the law very speedily as they had to, so we don't have a lot of detail. And as they come out with detail on how to calculate certain things, this is not something they've given us guidance as of today yet. Okay. But I'm pretty certain that that it will be very, very close to this. One of the things that some of my clients are doing, instead of using a 75% test right here, just for their own reference, they're using 80 just to make sure no one gets close in case they change some of their guidance. What we don't know, again, is you can see this pay period right here is January 3rd. Well, that was actually in December that was actually earned. So we don't know. If you look at a quarterly report, this will exactly agree to your quarterly report, but it wasn't actually earned in that quarter. So that's, again, we're waiting on guidance to actually determine what that test is. So this is going to be fairly close.
Okay. There's going to be some people too that are in this industry, that are in multiple industries that have seasonal work too. So that's obviously going to make some of these numbers, you know, wintertime, since do a lot with pools in the wintertime, a lot of the Midwest and stuff, their pool service and pool construction is slowed down. So it's going to be tough to compare pay periods, but at least for this perspective, this is the best we can understand how to address it until we get more guidance. So for moving forward, this is about as best as you could come up with.
Yeah, I do want to mention that the people who are not subject to this test are anyone who has annual compensation over $100,000, obviously is not subject to this test. Anyone who is no longer with you. For example, this particular person right here, Robin, me blind, is not subject to the test because they're no longer employed. So you have, their average is this. Actually, I take that back. They do have some data in here. But I believe this may be a flaw in our test data because we actually have brought them back when I don't believe in a normal case, they probably wouldn't come back. Let's talk about this case just for a second.
Sure.
What could happen right here is if someone was working, they left, and then they came back on a limited capacity, and which, you know, a lot of people did take off at first and came back at a limited capacity. You need to get them back up to this. But if they are gone and they are no longer in our test data, or they're no longer an employee, they're not subject to the test, obviously, because they're no longer here.
Okay.
So that's just something to consider as well. That if, you know, for example, if you had someone who was full-time and then all of a sudden they want to come back for just a couple of hours, that would really be punitive to you, because then you would have to maintain their 75. So based on the facts and circumstances of why they're not, if they have a, you know, valid reason why they're not coming back, then that would be something to consider.
Okay. That makes sense. So basically what we're trying to do is make sure that when we bring them back, if we bring them back, we need to bring them back at a similar rate as they were there before. Otherwise, they're not really helping the forgiveness cause anyway.
No, yeah. So you want to take that on a case-by-case basis and, you know, either compensate them at 75%, or, you know, if they're not coming back because they don't feel like it and they just want some more time off, it may not be a good time for them to do that. So again, case-by-case basis. So basically the importance of this is to understanding your test, understanding what your target is, and making sure on a pay period by pay period basis you're meeting that target. Okay, so that's test number 2. The second test is, the third test isn't really, I don't have any, let me bring up something real quick. So basically I want to kind of talk about now tracking your funds, okay? The third thing is you have to spend the money. Now we know how many employees we have to pay. We know how much each employee we have to pay. So the question is, what else? As you know, and you're well aware, you were given 12 weeks or 2.5 times your average monthly payroll, but you can only spend it over 8 weeks. So here are the other things you can spend it on.
Okay.
The first thing is, let's talk about what's included in your payroll costs. I want to say that you can spend up to 25% in anything other than payroll, but you can spend 100% of it on payroll if your payroll increased. Let's say you were a company with, who's increased its payroll since 2019, which a lot of people do, then it's okay. I'm telling my clients, take the low-hanging fruit. If your payroll consumes 100% of it, use that. Don't worry about going into the proving more and more things. You just want to prove the money. So start with what your payroll costs are and see, kind of do a projection of where you think you're going to land. Let's talk about it between payroll costs and anything other than payroll. So for just 1 minute, I want to talk about what's included in a payroll cost. Okay. When this CARES Act first came out, we were not sure what was actually considered compensation. We now know that it is gross payroll to the employee, which can be salary, wages, commission, or any similar compensation. A question has come up in our industry as to whether or not you can count bonuses in. We don't know. We haven't been given guidance. Another question came up as to, can we give people raises? There's nothing in the CARES Act that says you can't. What I will, just as the limitation on getting the loan was limited to $100,000 in compensation per person, the forgiveness is limited to $15,385, which is $100,000 annualized for 8 weeks. So again, your compensation is still limited to that amount. You can also add the employer cost of the group health insurance, which becomes important. You can add retirement contributions. Again, let's say that you have a 401k. The employee's portion is going to come out of there, so we will just count their gross. But if you have a match, like if you match their 401k, you could only do 8 weeks of that match to count in this particular compensation package. So when it says payment of state and local taxes, basically what they're referring to there is state unemployment, which is a very minor expense. So don't misread that to be any other taxes, because that's basically what it is. And as a matter of fact, for Arizona, that's what it is. If there are other state taxes that are assessed on your compensation, that would that would be included there. For Arizona, the only tax that would qualify for that would be unemployment, state unemployment. So that's basically the payroll aspect of it. Now I'm going to talk a little bit about what else is included besides payroll.
Well, before we go into that, let's talk about what about officers and how they might be paid. How are they considered as far as payroll costs? Do officers of corporations, do they have to receive paychecks based on that, or what if they take draws or other compensation? How does that affect the?
Yeah, that's a really good question, Rick. It has to be compensation via a payroll. It's the same qualifications for how you qualify for the loan. You have to be a paid employee. Like, let's say, for instance, an officer is paid a management fee as an independent contractor or something like that. That would not qualify. Okay. Let's say that you take part of your compensation in draw. That does not qualify as well. It has to be paid wages. And again, you can't use more than $15,384 or 5 rounding in your PPP loan to be forgiven. So yes, up to $100,000, if that's what their pay is, you can use that.
That would essentially have to be what was filed on your 940 and 941s in payroll only, not any other way to be compensated.
That's correct. That's exactly correct. Okay.
All right.
Any other questions on the payroll side of it, Rick?
I don't think so. I think that makes sense to me at this point. I knew that would be a curious question. There's a lot of owners of companies, and they like me even, and I'm compensated differently depending on which company or how the company's been formed. So that helps clear that up.
Yeah. So just to kind of touch on that one a little bit further, if someone were to be compensated in another manner, chances are they then under that other company may also be able to qualify for their PPP. So their compensation would come in under maybe their company, if that makes any sense.
Yeah, it does.
Okay, perfect. So let's go on to what else can we use. Really interestingly enough, in the CARES Act, I want to kind of point out one of the things it says. It's a little bit contradictory. It says that we can use the funds for interest other than mortgage interest on any loans that were in place prior to 2/15/2020. However, it doesn't say it doesn't say that those same funds would be forgiven, because if you look to the section 1106 of the Act, where it talks about the details of the items that are eligible for forgiveness, it doesn't mention interest other than mortgage interest. So a lot of folks say, well, it says that I can use these PPP funds to pay for my interest on a truck that I have, a company truck payment. And although that is true, when you look at the language on what can be forgiven, that's not there. So we don't know if that's an oversight or it's an intentional. So I am telling my clients, unless you need that to meet your paying out all your funds, don't use it, because we're concerned that they may not be able to use that for forgiveness. So my recommendation is just like what's right here. By the way, Rick, we can make this available too.
Okay, awesome.
This is put out by the CPA, and this is kind of their little real quick look, if you will, and this is dated for 2020. I would highly recommend, as people start looking at articles and reading articles and looking at documents, take a look at the date, because everything does change hourly, daily. It's kind of a very fast moving target. But as of right now,
just for curiosity, what does the AICPA stand for?
Sorry, it's the American Institute of CPAs. It's the governing body of basically CPAs. It's the federal. They're who the IRS listens to. They make a lot of recommendations. They are kind of our guru, if you will.
Okay, so
we'll provide
this.
We'll
provide this same document too in the other group of documents, so people have that. And if we get updates, we'll try to put them up there when we get them, because that's, like you said, the data of this stuff is critical, because they're learning and giving new guidance on a weekly basis, because they're finding the holes, and then they're finding a way to fill them. And then we have to adapt immediately to whatever their new rule might be. So we'll try to update when those updates come out.
Yeah, the other thing I would highly recommend, only thing we've been doing pretty much for the past 6 weeks is watching this and making sure we're staying current. I would say that there's some bad information out there. Make sure when you're reading articles and you're taking advice that is from a professional or a documentation or a publication from someone who you would want to take advice from.
Wait a minute.
Said,
are you telling me that the media and social networking and stuff, we shouldn't just listen to that? That should not be our news feed?
Yeah, if you just turn on one of your favorite channels, they'll know exactly what it is. Yeah, so please look for the professional journals. The AICPA is really good. The Journal of Taxation is really good. Some of those are written at a little higher level, but so the second group that we have, Rick, other than the payroll, is again the mortgage interest. If you have a situation where you actually own your building and you're making mortgage interest, this would be kind of the in lieu of rent. But most of us, if we own the building, it's in a separate LLC and we're paying rent. One of the clarifications that we were all very concerned about is if you pay yourself rent. So let's say that, I'll just use myself for an example. Our firm pays an LLC rent in our building, but I happen to own that LLC. And so I was concerned personally, like, okay, what would happen to this? But it did come out in a few weeks ago that you can do a self-rent if you're a self-rental. So if you own the building, they will not disqualify that rent. So that's good. So you see, it's going to pretty much be one of these. If you don't own the building, then you're probably paying rent. If you own the building, then you're probably not paying rent. But here's a little interesting thing. Rent isn't limited to, even though it does say here that interest is kind of going to be limited to mortgage, rent isn't limited to a building. So if you rent or lease a lot of your equipment, you can write that off and use that for your PPP funds according to all the information that we have available to us right now. So, and that might help a lot of folks out who rent equipment. But keep in mind, Rick, let's say you had to go do a job that you just contracted and you went and rented a piece of equipment. Well, because that rent or that leasing agreement wasn't in place prior to 2/15, that wouldn't count. But if you were renting something prior to that date, you can continue to use 8 weeks of that rental payment for the forgiveness.
Awesome. Okay, that makes good sense.
Yeah. Here's another, utilities. When you look at utilities, you think of, electricity, gas, water. But this transportation, this was a really interesting thing to our profession, which we were very happy when they gave us a little bit more guidance on what that meant. And somewhere buried in, the guidance was basically this was a construction a gimme, because they're allowing gas for company vehicles. They're defining as a transportation utility. So, which is really, really helpful when it comes to, again, that's going to help out construction folks a lot, because, that's a large part of their expenditures. I know I have some larger construction companies that gas is huge for them. And they said that they can easily take up their 25% with the gas that they use for the company vehicles. So sure. Just an interesting detail there. The telephone, that's pretty self-explanatory. The internet access, again, anything here has to be for service established, prior to 2/15.
Okay.
That's basically, where you can spend your money. So what I'm recommending that people do is get a spreadsheet, do some calculations, do some projections, know where you're spending your money, know, whether you need to spend more money on payroll. Do you need to, that's your only other choice. These things down here are all going to be pretty fixed, the interest, the rent, the utilities, but project conservatively what you're going to spend there, and then know, okay, here's how much we have to spend in payroll. Do we need to, is there some extra jobs we may need to take on? Is there some things that someone needs to do that we may need to hire a few more people to take care of some things because we have that? What you don't want to do is get to the end and realize, oh man, I didn't spend all my money, and it's going to be too late. So do some heavy projecting now.
Right. And the goal of this whole situation is to get the money in the hands of the employee, right? So even if we have to overpay our employees or add, like you said, do extra work now that we might have done 2 months from now, the smart thing is to project now, get that all paid for in advance so that you get it paid for, because it's going to get forgiven. Anything you let slide to the end, you're gonna end up having to refund the money or not give it forgiven. Take your pick. But if you have the opportunity to put money in employees' hands and get it forgiven, it only makes sense to plan ahead and project ahead, because the more you pay out, the more you get forgiven at the end. And it gets it where it's supposed to be, which was in the hands of the employees, not back in the government's hands and not stuck in your company getting taxed.
Yeah, like I said, in meeting with all of our different clients, everyone's kind of trying to come up with a few different things. We have some people that are bringing people in and having them do deep cleans. We're having some people where they're paying their laborers, an extra $100 a week if they show up all five days. They're giving, their superintendents a little bit of a bump every couple weeks for hazard pay. Be creative within the CARES Act, and check with your CPA as to what's allowed as of the day they're checking. Sure. And to make sure they get that money spent properly. They may as well, or they're going to give it back.
Right. Okay. What was on the very end of this sheet we're looking at now? I thought there was one more thing. Did we not cover the final?
So it's called, and I didn't talk about this. This is your EIDL loan. So keep in mind, there's a difference between the EIDL loan and the grant. As most people know, everybody applied for the EIDL loan because there is at the very end of the application, it says, would you like $10,000 now? And everyone says, yes, please. And based on the number of employees you have, they gave you up to $10,000 as a grant. If you had up to 10 employees, it was $1,000 per employee up to $10,000. So if you got an actual SBA loan, which is this EIDL loan that we're talking about, that's not the grant. So you can refinance that into this, but I don't really want to go into the detail of that right now. It's very, very complex.
Okay.
But this doesn't include the grant. So the grant money from the EIDL loans that, they're really not loans, but they're grants up to the $10,000 can be used for anything, whatever you didn't use your PPP money for. So for example, it's a much broader category. You can use it for any working capital. So for instance, if you had some supplies you needed to buy, that's what you could use your grant money for. So as long as you don't use it for anything you're counting toward your PPP loan, you should be okay, and that will not have to be repaid.
Okay. Well, a couple of things, Dan. That was a lot of information very quickly. But I think the critical thing is reach out to your CPAs and get in touch with them today as soon as possible. Make sure you're planning to get all of your PPP money forgiven correctly, meaning you got to plan early. You can't wait till the last pay period to figure out you haven't spent $100,000 and where are you going to put it. You need to be planning ahead correctly and get the money where it belongs, in the hands of the employees as much as possible, and work with your accountant to be creative to make sure that it all can be properly forgiven and accounted for correctly. So again, we are going to make sure that we provide a copy of the spreadsheets you looked at today. We'll put them up on our website. We'll also make sure to put this piece of information we just went over from the super duper accounting group that I can't remember the name of. But we'll make sure that information is out there for you. Diane McCullough, you are awesome. You've given us a great wealth of knowledge. Anybody else, obviously you can comment on our videos when we put them out there. Make sure you're liking and subscribing to our YouTube channel, because we will make sure you get more updates as this comes out. Diane, thank you for coming on. This is Rick Chafey with Ask the Masters.
Absolutely.
Thank you very much for that insightful piece of information. It's hard to digest all at once, but it's super, super critical to making sure you get your PPP forgiven.